Okay. I am going to avoid making lengthy opening remarks, and I thought because throughout the day we have not given you enough time for questions, we'd like to leave lots of time for questions. Can you hear me now? No. And I sense that there are a lot of questions in the audience, which reminds me of the story about the British diplomat who was granted an audience by Chairman Mao, and he decided he was going to ask him a seminal question. So he turned to Chairman Mao and asked him how the world would have been different if Khrushchev had been assassinated instead of John F. Kennedy. Chairman Mao stopped and thought about it for a moment and responded, "We know one thing's for certain, Aristotle Onassis would not have married Mrs. Khrushchev." Our panel this afternoon is charged with peering around the corner and reimagining the future of financial services. We've heard at some length today that this is a defining moment for the financial services industry. I've encouraged our panelists to unburden themselves of what keeps them up at night and to share with us policy recommendations to address their concerns to restore the long-term integrity of the financial system. We're going to begin with Sir Derek Mon, who needs no introduction to this audience. Sir Derek is currently a partner at Kohlberg Kravis Roberts and chairs KKR Japan. Sir Derek.
Well, good afternoon, everyone. It must be a very slow day for you. I don't know how many of you know Alan Bennett. He's a British man of letters. He wrote a play called The History Boys, in which a famous line appears that history is just one damn thing after another. Actually, he was somewhat more profane, but you get the idea. I lead the financial services group at KKR, and I have to say the last year and a half has just been one damn thing after another. The lost weekends at Bear, at Lehman, at AIG, the fraught conversations with Washington Mutual and Wachovia, and the continuing conversations with parties who've asked me not to name them. In our view, this crisis is bigger and more pervasive than any before. And I say that having started life in the British Treasury when in the 1970s we had to apply to the IMF for a bailout. I say that having lived in Japan in the 1980s when the boom went burst. I say that having guided Salomon Brothers through a near collapse, and having served at Citi and been directly involved in the Latin American, Asian, Russian, and other defaults. We passed the hat, as I recall, for John Merriweather, but not for Boris Yeltsin. This is more profound, and its consequences will be, I think, historic. Big words. Now, what makes this crisis different? Well, some things are common. Human psychology, intellectual arrogance, asymmetric incentives, and weak governance structures. Certainly every mistake that I've witnessed over the last 4 decades showed all those characteristics. And some of them are hard to eradicate. It's possible people could become humble. But what makes this different? Well, the scale of the losses. Scale matters. The IMF estimates the losses in this credit cycle at $4 trillion. We've certainly not seen anything like that before. which pretty much wipes out the capital base of the entire banking system. Second thing, the proliferation of highly structured, leveraged financial products with little or no capital to back them up and little or no understanding of how those products might behave going forward. Third, this crisis has triggered, unlike any of the previous crises, a global recession with a collapse in industrial production and a sharp contraction in world trade. And fourth, as you've probably heard, I'm sorry I couldn't join you earlier, the political response that this crisis has called forth, with governments everywhere compelled to inject bank equity, guarantee bank debt, take bad assets, and ring-fence others. Here in America we have, correctly in my view, undertaken massive, quite unprecedented, and ultimately unsustainable fiscal and monetary stimuli, hoping to stem the economic collapse while we shore up the banks and get credit flowing. It's a race against time. And the consequences. We can already begin to discern certain consequences of this crisis. The first is, regrettably to this audience, that US leadership on global economic and financial policy has been substantially diminished. For all of my life, the Americans took the lead in terms of power, but also persuasion, in making the key appointments and making the big calls. Our moral authority is not what it was, and the evidence is not in our favor. And I do not believe the Europeans or the Asians are listening particularly closely to what we have to say. Second, the global economic recovery will be muted. That's the way it is with balance sheet recessions. It is going to take us some years to work our way through the leverage that was accumulated over the last 20 years. It follows, third, that future growth will come from productivity gains, not leverage, and, in our view, the cost of capital will rise throughout the economy, both for households and corporations. Just to give you an idea of what's at issue here, bank debt, the degree to which banks levered themselves in order to lend. Bank debt went from $5.3 trillion in 1997 to $17.2 trillion last year. That is from 64% to 121% of GDP. We don't know whether 17 backs down to 12 or 10. If it goes all the way back to 5, that's a real issue. And it will certainly put a lid on asset prices. Fifth, a sharp correction in global trade and capital flows is already taking place. We could discuss this further if you wish, but is likely to put pressure on the dollar. Our government is due to issue $2.75 trillion of debt this year, with the Japanese trade surplus having evaporated and China redirecting its resources to domestic demand. So the supply of government bonds is up, the available resources are down, the price can adjust in one of two ways, or both: raise the interest rate or drop the dollar. We will have, beyond all this, a major challenge in navigating the medium-term transition to long-term fiscal sustainability and reeling back the quite extraordinary expansion in the monetary base. For the financial services industry, the IMF, as I mentioned, estimates that banks globally will lose about $4 trillion, of which only about a third has been recognized to date. We're often asked, are we halfway through the movie? What innings are we in? That's difficult for an Englishman. There are only two. So I guess we're still in the first innings. But in the US, the losses in the next 2 years, and you can see now I'm beginning to focus on the stress test and the capital that the banks will have to put up, numbers to be declared a week from today. The losses are put at $550 billion, with over time an additional equity requirement of $275 billion. If you look, that's for the system. If you look at the stress test itself, it was applied to 19 institutions, of which 12 are banks. The market currently is guessing that the equity requirement for those 12 banks might be 50 to 70 billion, and that 8 or 9 of the banks will require additional capital. Where is that capital coming from is something that Gary can answer for you.
I'd like you to donate, Gary.
I would say, for all of the criticism, the stress test does seem to me to be thorough and a quite professional assessment. And what really matters is, at what capital standard would we judge the system to be safe and sound? One thing seems clear, though, which is that we will have significant public shareholdings in our banks for the foreseeable future. 542 institutions have received TARP so far. We tend to focus on the familiar 10 or 12. 542. And if the TARP already supplied to the top 10 banks in America were to be converted into common, we, the voting public, would have a 27% voting share in those banks. This raises to me some quite complex questions of both goals and governance. I commend to you a short piece in the Wall Street Journal last Friday by Robert Reich, who asks, are the goals of these government-owned banks to maximize social welfare, extend credit, lower interest rates, grant access, support industries? Or is it to maximize profits? And how will accountability be exercised if trustees are appointed who are neither accountable to the Secretary of Treasury nor to shareholders? I don't have answers, but these are questions that we need to answer if we're to attract private capital and if banks are to begin to function in the ways that we expect. The only other thought I'd make for now would be this. It's not all about the banks. If you were to look at loans extended in the American economy today, only 45% come from banks. 55% come from the non-banks, or pejoratively, the shadow banks. Nothing good happens in a shadow. But there are 14 trillion of assets that currently have no natural funding base because the capital markets and the securitization process shut down. And a good many of those companies, which are familiar to you, credit card companies, leasing companies, consumer finance companies, car loans, and so on, are in what I would call orderly runoff. Now, it's true the Fed has stepped into the breach and extended $2 trillion, but that's still 12 to go. All offers welcome. But propping up the banks is one thing, but it could be more than offset by contraction in the non-bank lending institutions until such time as we can get confidence re-established in structured and securitized bonds. I will leave it at that. It's not as bleak as it sounds. Prices are incredibly low, and if we can figure out these balance sheets, there's some terrific deals to be done. Thank you.
Thank you, Derek, for that sobering assessment. And now we're going to turn to Magnus Bokar, who is the president of the NASDAQ OMEX Group. Hopefully he'll be a little more upbeat.
I'd take the same position here. I don't know whether that makes it more... Could I be more sober, more... whatever I say will probably sound pretty optimistic. But still, one damn thing after another, to quote Derek. I can't resist, Derek, even though I didn't think to start there. Have you had such a fun things going on? I mean, you talk about what did you do in the 70s, what did you do in the 80s, what did you do in the 90s, and now you're here, and you still smile. There've got to be a few good things in between. I think there is... my remarks, as a starting remark here, is that unfortunately I will not give such a upbeat message either, even though there is a few lessons learned over the last 2 years that I like to share. And therefore I also think within those lessons learned there might be a few things that will take us forward. And I'd like to continue with what Derek said, and there's nothing good that happens in the shadows. And I think one of the most important things for where we come from over the last year is the importance of transparency and trust. The importance of whatever financial markets do happens in transparency, in the light of understanding, and therefore creates trust. I'm very honored to represent the exchanges here, the stock exchanges or the derivatives or exchanges or commodity exchanges. There is no doubt that lessons learned over the last 2 years is that the business model of exchanges is a fantastic business model. Never during these 2 years or year and a half of crisis have we been dysfunctional. We've been open every day, we've been trading, we've had phenomenal good liquidity in the market. You might not always like the prices, but you can be trading every day. Every company being listed, every company that's on our markets, whether it's here or another market, have been able to issue capital. Meanwhile, these companies will not be able to go to the credit market. Most of the problems we've seen over the last the recession, the crisis, is the lack of function, the lack of transparency and trust in the credit market. Whether we call them seed credit default swaps or whether we call them different names, but they are traded OTC, they are traded outside the public domain of control, transparency of price, and therefore also the trust what's behind them. There is no doubt that some of the defaulting banks we've seen have been leveraging those products far more than they were able to take care of it. So my first reflection about the lessons learned is that exchange business model turned out to be a very good business model. It's a business model of 200 years, and it will therefore, I think, be the business model for the future for very much of taking care of the risk, to take care of how to distribute risk among investors and companies. The second observation in my lessons learned is technology. There is no doubt that the importance of technology, how we've been able to adopt technology to create information, how we today know what's going on all over the world, how we use technology to take care of that, how technology today is used as an important tool to reduce the friction cost, the cost of transporting risk. I think therefore technology and the use of technology will be an even more important thing going forward. The third one, and still this is in the context, I'm trying to break off Derek's a little bit more dampened view of the future. We're still here to talk about whether there is a future. The third of my lessons learned is services. There's no doubt that we as financial services organization, whether we are investment banks, whether we are banks, whether we are exchanges or any other players in this one, we need to think more of what's the value to our customers, the service organization. I think we have lost that. We lost the customer. I feel greatly today among many of the bank CEOs and what they do and what they put their time on, but I think they meet very few customers at the moment. I think that many of the customers out there is thinking about to whom are they customers. And I think that who are the one carrying forward services going forward will be extremely important. My fourth lesson, my fourth remarks is according to regulatory. I know that you've been talking about it earlier today. I think there is no reason to get it too further, but I think we will see regulatory things in two aspects. I think the importance of and the risk of regulatory change that will have negative effect to first maybe the financial industry, but that will naturally spread to be negative to the economy is at risk. I'm very afraid that we will have more regulatory things coming in, creating more problems than it actually trying to solve. There's no doubt that we need new regulatory regime, but we don't need more regulatory issues right now. We need the right regulatory schemes, and I think that's extremely important. We don't need more, we need the right ones. I think there will be certain countries in the world that will be much faster to adopt more modern regulatory regimes. Countries that have a lot of trust. And I think those countries will have an advantage towards other countries. I think that's a risk from a US perspective, that other countries suddenly becomes far more attractive to do business in than the US, and suddenly companies start moving. In the world of where we are today, companies are very easy to move their business much faster than we used to be, and I think we will follow that. So we see the risk of regulatory things will therefore be very strongly focused one way. Where will the right regulatory regimes be that is trusted, transparent, and create the right environment for companies? And a regulatory regime that also creates innovation. I think one of the things we have learned is that we learned that the bad things about certain products, certain issues about future products or CDSs, don't blame the products. Since I'm a Swede, it's very easy to blame Alfred Nobel for the dynamite, because you could easily get hurt if you use it the wrong way, but still, it's a wonderful innovation. And I think when it comes to financial world going forward, the financial services sector, the importance of product innovation is extremely important. And we could make a lot of things coming out of that innovation world, but we need to have transparency. We need to see what it causes, what it needs for. But I think that's the second thing out of the regulatory. So my starting remark is very much into transparency and trust, open markets, transparent market, which I think exchanges or exchange-like entities could give. The second one is technology, adopting technology, developing technology in order to create more efficient, less friction in any market, so you get capital where capital should be. The third one is how do we get service to the clients? Who is actually the clients out there, and how could we get the service to them so we service them and not ourselves as financial organizations? And the fourth one is the regulatory piece. How do we get right regulatory? Where in the world will the right regulatory with the right trust and transparency be in order to continue to develop? So that would be my 4 starting points. I think, therefore, when I listen to our 4,000 listed companies, when I look into the backlog of IPOs, I'm maybe a little bit more optimistic. I think most of our companies we talk to start to have their hands around the problems. I think that's a pretty good start. They see where they are, they see the problems, they are far from through it, but at least they are much more focused on the effects right now. The IPOs and the IPO market, given that we're not seeing any huge changes from where we are today, We have approximately 160 IPOs in the queue right now, and they're spending a lot of money to keep that updated. Not all of them will come to the market. It wouldn't surprise me if we, within a year, 4 quarters from now, will have a little bit different IPO markets and interest to companies to come to the market. That will be my little upbeat end to it. Noel?
Thank you very much, Magnus. Our next speaker is Annette Nazareth, a member of the Financial Institutions Group at Davis Polk and Wardwell, and a former SEC commissioner.
Thank you. I think it's fair to say that my perspective and remarks are certainly colored by my personal experience as a securities regulator of the last decade, having retired from the SEC just a year ago, and also as a 9-year member of the Financial Stability Forum, which will now be the Financial Stability Board. And I have to say that I come, therefore, with a great respect and admiration for the power of regulation, but also with some concerns about its limitations and the expectations that we all seem to have, given that we all have views on what the lessons are that we've learned, and therefore we seem to have an optimism that we won't make these mistakes again. And I certainly hope that's true, but I'm not quite sure I believe that will be the case. My perspective on lessons learned, I thought I would share with you a few things. One is that, and others have mentioned this as well, we really do have to focus on better corporate governance. Corporate governance is something that the SEC, was sort of, I always felt was being talked about and indeed fought about in our society as a very academic matter. And I think that the recent experience has shown that corporate governance is more than an academic matter. The colossal failures that we saw in a number of the major financial institutions, I think, really does show that we need much stronger boards who are much more focused on the risks and the businesses of the firms that they oversee. They need to be much more aggressive in ensuring that incentives are aligned within their organizations to ensure that the risks that are undertaken are not disproportionate with the rewards. Certainly, all the talk that we've heard about with respect to executive compensation is entirely appropriate. Executive compensation was really quite out of whack, and we can sort of say that freely now, and without being viewed as anti-free market. The risks that executives took in order to ensure that they got much higher compensation was not in the best interests of shareholders, and that's something that I think we need to focus on more going forward. I think even issues such as say on pay, which have not been particularly popular in this country but have been adopted in other jurisdictions, I guess my own view is I don't understand why we're afraid of that. I mean, having some sort of check on executive compensation and, frankly, on board issues in general, even with greater access to the proxy, is something that we should seriously consider in light of our recent experience. I think recent experience also shows that risk management was nowhere near as robust as we might have thought. Certainly, I think there were a lot of improvements in risk models, but our faith in those models, I think, exceeded the justifications for that faith. Risk management techniques, I think, had improved, but not to the extent that we relied on them. Certainly what we found, even at the Commission, was that the disregard for tail risk, I think, was quite troubling. That at some point you can sort of reverse engineer the risk models to give the result that you want, and that's a very dangerous thing. There was a little bit of mention earlier about credit default swaps and the risks that were inherent in those. I mean, there were many products, obviously, that were highly levered products that the risks of which and the need to provision against were not fully comprehended. I have to say, what we found at the Commission was really quite startling. When we first saw the problems in the credit default swap market and in the ABS market, we went into the firms and looked at how they were valuing these positions. And what we found was, particularly with respect to ABS, that the firms were, in many cases, not tracking how the underlying assets in those securitized products were performing. A lot of those assets, I know in the banks and in some of the investment banks, were in special purpose vehicles. They were sort of out of sight, out of mind. And there was a almost blind faith in the credit ratings that those products had, and therefore the markdowns on those positions were non-existent. They were being held at par, which was really quite astonishing, given that under the capital rules and under Basel as well, if these positions were in the trading book, which they should have been marked to market, and there should have been more rigorous analysis. Indeed, what we found at some places was when we went in and we asked them to value on their own and to not have blind faith in the credit ratings, there was a sort of flurry as these firms had to go and actually gather the data to figure out what the underlying assets were, which is quite astonishing, given that we all thought the risk management was far more robust than that. So that obviously has been a real lesson. We need a lot better risk management at the firms and a lot more rigorous assessment. And certainly another lesson in that regard is that a lot of the, at least at some of the firms, it turns out that risk management didn't report into the right way, that they were reporting in some cases to business lines as opposed to independent areas of the firm. Obviously, that's a highly dangerous situation and something that is fraught with conflict. Another lesson, obviously, that we've all learned is that capital matters a lot, and that there were also some limitations on capital measures. Some, again, sense that we could have done a better job of measuring capital. Cushions are much more important than perhaps was given credence to. I have to say my experience with the Consolidated Supervised Entity Program was that the brokerage firms were actually not happy with the SEC, that the SEC did not let the firms rely solely on value at risk modeling in valuing their positions for capital purposes, because we did not have sufficient faith in those models. The firms, fought back very hard on that, and in fact were arguing, well, if you don't agree with VAR, given how scientific this all is, if you're, so in the dark about this, well, we'll triple it. We're willing to triple the capital charge that results from these analyses. And of course, our response was 3 times 0 is still 0. No, in fact, we're going to put much higher plugs onto the calculations. And so, I think again, there's much to be learned about how we need to look back on the capital regime. I think in general, Basel had much to say for it, and I certainly wouldn't throw it out by any stretch. I think there's many, many good things about it, but I think we have a better recognition now that things happen, that there are things we don't know, that the capital formulations themselves assume that you understand the risk as you're sort of working your way through those models. And if you don't understand the risk, which is what happened here, we didn't understand the risk of some of these products to the tune of trillions of dollars, you can be way off. And whatever you thought was sufficient capital is grossly insufficient. And that was a very unfortunate lesson. Another lesson was that leverage really did matter. At the Commission, we had a lot of focus on liquidity. There was never a leverage test for investment banks. Investment banks, by definition, were levered entities. And so, but there was, again, a lot of focus on capital and on liquidity. But what we found with Bayer and others was that there were more issues involved. With Bear Stearns, what we saw was that the funding sources completely dried up. One thing that was not comprehended in the SEC's model was the notion that for an investment bank and for all of these banks that relied on overnight funding, that literally you could have a situation not where you had a 10% haircut in funding your overnight treasuries, which was the absolute worst case, unimaginable situation that the SEC had modeled for, but that basically you'd have a 100% haircut, that at some point the marketplace would decide they simply didn't want to deal with you. There had been a complete loss of confidence in the institution. And so that is a big lesson. I think thus, all the investment banks decided that they essentially could not survive without access to the Fed window, because if you have a situation where your funding sources can completely dry up on the overnight window, then you must have access to the Fed. Ultimately, what this has brought us to is a recognition that in general we do need a better regulatory framework, and others have referred to that. I think there's lots of opportunity to improve and to streamline our regulatory processes. I think I would agree it's not necessarily more regulation that we need, but much smarter regulation, more thoughtful, more streamlined, but in some cases more severe, I suppose, and more prescriptive regulation than perhaps was talked about in the last couple of years, when all we talked about was prudential regulation, light touch, and the beauty of the free markets. And ultimately, I think there's also a recognition that we really do need some sort of systemic risk regulator. It is interesting to me, having been on the Financial Stability Forum, that there's almost nothing that occurred that had not come up in some conversation, in some dialogue over the last several years. There was talk of different, different trends that we were seeing. But taking all of those little trends and those little factoids and connecting the dots to bring us to where we are today was almost inconceivable. And we have to hope, and I hope this will be the case, that if we have a systemic risk regulator, if we have a bit more concentration of the view, the 30,000-foot view, by some regulator who's looking at all of these activities together, that there will be a better sense of where the really big risks are, and that we can try to address them. Thank you.
An honor to be here with the fellow panelists who I've known and had a great deal of respect for a number of years, and an audience that actually could be up here talking instead of sitting listening. A number of you I know quite well and awfully distinguished and experienced. In this gloomy time, and particularly after lunch, I mean, who wants to hear from a former regulator, right? So I was going to tell a joke, but I thought better of it because when I'd been controller of the currency, my first speaking event was before the American Bankers Association. It used to be that they had 10,000 people, some fancy resort. Now it'll be bread and water probably somewhere on Lexington Avenue, but in those days it was a big event. And they had the big screens, and they projected your visage on the screens, and you spoke. The first thing I said was, I'm going to tell a joke. I told a joke, gave my regulator speech. I did the same thing at the second event, another big event, then another third event, and just as I said at the third event, same kind of format. I want to tell you today my joke. Somebody in the back of the room where that gentleman's standing jumped up and he went, which I took to be a signal that they did not want to hear the joke. So I didn't tell it, and as I was walking out of the venue, I bumped into the fellow who'd made these hand motions, and it turned out it was one of my employees at the OCC. So he said, before I could get out a word, he said, put his arm around me, he said, "You don't understand, as controller of the currency, you meet every day with the chairman of the Fed and the secretary of the Treasury and discuss important matters. You're far too important to tell jokes at venues like this." So I bought it, of course, like any sort of new government official. Then at the end of my term, after 5 years, it's a 5-year term for controllers, they have a silly old ceremony where unveil a portrait they painted of you. Mine, I think, today is hanging in the garage of the OCC, if you'd like to see it. A very handsome portrait in the garage. And it's one of the few times in government where they serve alcoholic beverages. They unveiled the portrait, and after a few drinks, this same fellow who had made the hand motions, said how important I was, came up to me and he put his arm around me and he said, "You know," he said, "do you remember the time I told you how important you were?" And I said, "Yeah." He said, "Wasn't true. You just tell jokes so badly." So that's it for jokes, even in a difficult time. I want to cover 7 points today, and I commend the formulators of this panel for focusing on the future, because I really think that we are at a stage in the crisis where the issue is not so much coming up with new ideas as it is simply executing on the ideas we have. And I think we can't understate what a magnificent job regulators around the world, financial institutions have done in responding to the regulators in this very difficult time. I mean, people at the New York Fed were literally sleeping there all night and working into the weekends every weekend. So a terrific job. We've now set our course in the new administration. I think the course is a sensible one, and the issue before the House, it seems to me, in building trust is not change in ideas, it's execute, execute, execute. I mean, whether the ideas are perfect or not perfect, it doesn't matter so much that we execute on the ideas and execute on them well. A second point is that, of course, we are in a re-regulatory environment, and that can take many directions. One thing is certain, and unfortunately it will be the case over the next 2 years, that the regulators will get tougher and tougher and tougher. The dynamic of a cycle for a financial services regulator is something on the order of press interest, congressional interest, you're called up for past mistakes, and the several thousand employees you have out in the field who have been doing their job day to day are affected by that kind of intense interest, and they become tougher and tougher and tougher. And that is going to happen over the rest of the cycle. Second thing, of course, is that we are in fact going to have significant re-regulation on a global basis in a new format. I think it's likely there will be a systemic risk regulator or regulatory body or something, but while I think the actual form of what we do is up in the air, the fact that we're going to do something eventually, I think, is clear. It may well be less robust than is brooded about in the press, but it will be significant. Third, I think the big issue is not first how do we regulate. I think this is a terrible mistake. It is what kind of financial system do we want to have. The financial system, what kind of financial services made available by whom, seems to me to be the lead question, and then you figure out what the regulation is, not how do we regulate, and then, oh, what's the financial system going to do for the well-being of the United States or the globe. In that regard, I see two serious dangers. One is that we're going to have very large public utilities that used to be vigorous banking organizations. I think that would be tragic. I think there is a huge danger of that we get into a mode where we have overcapitalized, overregulated public utilities that are no longer vibrant and innovative. But I think it's a genuine danger. Second danger is exactly at the other end of the barbell, that we forget about the community banking sector of the United States, which is one of the things that makes the United States so very exciting. The community banks around America, over 8,000 of them, have provided a lot of the innovative capital to start-up enterprises, and in this environment there's a very great danger that we'll lose that sector. We're certainly going to see hundreds of additional banks fail or be resolved, and what we do with the sector is important. Point number 5 I wanted to make is that the biggest danger we face beyond what we do with the financial sector is that we as a nation, and particularly in the area of finance, lose our nerve. That we certainly have had a hiccup, serious, traumatic, worst since the Great Depression. But it really is a result of innovation and technology, the two major forces of our time, technology and globalization coming together, and an innovation that's resulted in efficiencies in the financial sector that, lest we forget, these innovations have really driven the world to a greater degree of prosperity than anybody has seen in history, not just 1,000 years, in history. And we are in tremendous danger of losing our nerve. If we lose our nerve, we'll subject ourselves not just to a lost decade, but to many lost decades. So we can't lose the innovative spirit. Point number 6, I would bet on America. At the end of the day, as bad as this still is a nation of innovators. I agree with what Sir Derek just said. Without question, we have clearly taken a hit to our prestige. I gave a talk at the International Conference of Bank Supervisors. It's a lecture one gives every 2 years. It's a distinguished thing to do. 139 different countries, and the hostility towards America. I hope it wasn't my speech, though could have been. But I think the hostility towards the country and what we put the world through in terms of this crisis was certainly palpable. But at the same time, I would bet on America, and I would also bet that the innovation will not be stifled for long. And the reason for that is that, in fact, the drivers have been world forces that have not been just the imagination of people on Wall Street making money. It's easy to find scapegoats, but in fact, it's been innovative forces, technology leading to a greater degree of globalization, which have caused the developments we've seen, and I think will drive the developments of the future, frankly, whether we like it or not. So, with that said, I'm looking forward to questions. Thank you very much for having me.
Thank you, Gene. Our last panelist is Gary Parr. Gary is a veteran investment banker and is currently deputy chairman of Lazard.
Thank you, Bill. Thanks. It's a privilege to be here. I'm a basketball fan, and it just occurred to me just now as I was walking if you know the basketball team, particularly college basketball. So what's just happened is I've been sitting on the bench while the team has been playing a great game. And there's about, if I look at the clock correctly, about 30 seconds left to go, and we're up by 20 points. And the coach has just allowed me to go on the court, so I kind of know what I'm supposed to do. Let me make a few quick points rather than replicate. I'll just build on and be maybe very specific on some forecasts short term. There will be more losses in financial institutions, hundreds of billions of dollars over the course of the next 6 to 18 months. That's on a global basis. Indeed, in the U.S., my guess is it will be a couple of $100 billion at least. So echoing Derek. Given that's the case, there will be a need to raise substantial common equity, hundreds of billions of dollars likely. Some portion of that will be earned by earnings. I'll take an aside. The banking business today, if you have a deposit base, is incredibly profitable on the margin. The new business, so if someone is clean and have dealt with their past, the banking business is incredibly profitable. The problem is dealing with the past. So as to opportunities, look for the institutions that indeed have dealt with their past. The incremental marginal new business these days is very profitable. But having said that, for many big institutions, the profits that they are deriving from their business today will not be enough to fill the hole of the incremental losses. They will have to raise substantial common. The primary provider of common over the last 6 months and on a global basis have been governments. I expect that to continue, that the primary provider, so in a sense I wasn't joking when I said to Derek when he said I'd know where to go look for the money, it's you. and you. We as taxpayers will continue to contribute because the private capital markets haven't come back in size to deal with this issue yet. There will be opportunities. It's not zero. We had the pleasure of advising Mitsubishi investing $9 billion into Morgan Stanley. There is money available for particular transactions, but not enough to deal with the systemic issues. So with losses more common to be raised, it becomes fairly easy to predict that it'll be government activity It will likely come also in the form of conversion from preferred into common. Expect to see some big numbers of those conversions. It's the easiest way, if you don't want to write an additional check, it's the easiest way to deal with a balance sheet issue and push money, capital, into a lower capital, that being common equity, tangible common equity, which is the shortage today due to the losses. It's fairly easy to predict as well, given the nature of things we're working on. There will be a fair number of continuing bankruptcies of financial institutions. I will draw a line and say I don't think it'll be amongst the big 19. The government has effectively said they don't wish for any of those to go bankrupt in a Lehman-esque manner. There may be orchestrated transactions and mergers. There may be events that deal with institutions, but I do not expect to see a Lehman-esque type bankruptcy of a big institution. I do expect to see a fair number in mid-sized financial institutions that for one reason or another have difficulties and do not pose systemic risk. The easiest way to predict whether someone will be allowed to go bankrupt, I think, is whether the government believe that they pose systemic risk. If not, they can go. In the intermediate term, a few quick things as to, again, forecasts or views about the industry. One is, in a sense, I'm hopeful that there will be more regulation, and I am really hopeful that it will target risk, that there'll be a lot more regulation around risk, different risk metrics, ways to measure risk, not only capital but liquidity, in a variety of forms. That would be good regulation. The dangerous type of regulation would be, for example, a number of people discuss sometimes, did all of this arise due to Glass-Steagall going away? My answer would be definitively no. The core part of Glass-Steagall had to do with separation of investment banks, business, securities business, and banks, and I would hold out as evidence Washington Mutual and Wachovia, two of the biggest wipeouts in the last year. Both, they went down due to a banking business. Didn't have to do with the securities business per se. Obviously, Lehman and Bear Stearns went due to securities risks, but it wasn't because they were in both. It didn't have to do with the core Glass-Steagall principle. So with that, I hope we won't go that route because I think it's unnecessary. I do think a lot of regulation of risk. One last way in looking at forecast, it is likely we come out of this with between 5 and 10 major global financial institutions that are full-service providers. Those entities are necessary. The way the markets work, the way the capital markets have now evolved to where we are today, there is a need for institutions that can source capital on a global basis when the markets come back. So some number 5 to 10. It takes a lot to be a winner on a global scale. So not a lot of people can get there, and there'll be an interesting process over the next 3 to 5 years of sorting out winners and losers, who can be the global players and providers of capital. On the other hand, there will be a number of specialty firms providing services. Many times I'm flattered many times people will talk about firms like a Lazard and say, yes, there's a place for the niche firms. We believe there is. But there'll be other types of specialty firms as well, so not just merger or strategic advisors. There will be risk takers. And so I would guess we will see some number of very interesting institutions exist between 3 and 7 years from now that will be the next generation of hedge funds. They won't be necessarily or just in the asset management business, but they will be in the trading and risk-taking business, and they will look a lot like proprietary trading desks. Therefore, there ought to be some regulation. So I'll come back to regulation of risk. As I said, there should be. But there'll be a lot of institutions that preferably should be private because they can therefore deal with volatility better. Meaning they can afford to have volatility yet manage their risk profile such that they're not worried about a stock price or evaporation of their access to the capital markets from an equity point of view. So that's an interesting as innovation. Look for specialty firms providing a variety of specialties and growing up very fast. Great opportunities for some number of those providers. And lastly, the bit of advice to governments. Much of the last 18 months was extremely well done by governments around the world, dealing with situations that they hadn't anticipated, and therefore, in many countries, including the U.S., many of the decisions were made ad hoc. They had to be. What do you do when you've got Bear Stearns? Literally, I was advising Bear Stearns, we had from Thursday night until Sunday night to figure out a solution. Then you roll into other circumstances where it's measured in days. What do you do? It becomes ad hoc. Things are not as bad today as they were last year at various points in time, notably September. We're not in a crisis mode. We're not spending as much time with a 3-day shot clock to reach solutions. So the major lesson learned was ad hoc works when you're in trouble, but it creates precedents where it will scare away private capital. Sitting today, if you don't know as an investor in any large financial institution that may need more capital, if you don't know whether the government will do an AIG or do a Lehman or do a Citigroup third recapitalization, each one of these treated the common shareholders very differently. And if you don't know how the government's going to come at you, it's, I think, speculative to say the least to buy the common stock because you just don't know. So I think we're in a great place for government to have additional systemic solutions, plans where people can understand if this, then that, and then this. Once you know a roadmap, then you can raise capital from third parties, from places other than government. That's being worked on, and I look forward to it being rolled out over the next couple of months, particularly in the U.S. I'll stop there. Let us get to Q&A.
Well, Gary, thank you for those insights. And I have been handed a note suggesting that we take a few questions and have you out of here by 4:15. Are there any burning questions that members of the audience would like to ask? Yeah, rear of the room.
Thank you very much. I refer to confidence. We can discuss at great length what's going on, what happened, and so forth. However, the reality is that the average American, because of a variety of things with which you are familiar, lost approximately between 30 to 40% of his assets. This greatly undermined the confidence in the functioning of the investment industry. I don't refer to banks. How can the industry rebuild the confidence in itself, the confidence which was gradually destroyed through 20 years of deregulation and creating an atmosphere where things could be leveraged, balance sheet could be leveraged 30, 40 times? Thank you very much.
Thank you. Let's try to batch the questions. And yeah, right here.
Good afternoon. Paul Franklin from Arup. We're in the consulting business, and we're involved with infrastructure projects and so forth. It seems to me that one of the big needs is to be able to provide financing to alternative energy, infrastructure development, those kinds of things, which are part and parcel, I think, of what financing companies should be doing. I guess my question is, we've heard a lot about, banks and the struggles that people are going on, but we need to be looking forward into financing real needs. And I guess, my question is, what is your perspective on, how you take these lessons learned and make decisions going forward, so that things really will be different in the coming years?
Yes, one question over here.
Hi, Emily Altman. I think I'm reading this right, that while we've been here, Sheila Baird at the Economic Club announced that she wants to seek power to shut down systemically important financial institutions and take them over much the way the FDIC normally does, imposing costs on investors and shareholders as opposed on taxpayers at large. Now, I know there have been some arguments that that may be roughly consistent group because investors and through mutual funds. You want to comment on that?
Okay, why don't we open this to the panel. Gary, you want to start? Confidence. How do we restore confidence?
Yeah, I was going to start from the last one first. That only to say that it is one of the core issues. I think the government's ability to step in and surgically take over an institution is an important power. I view, again, evidence, Washington Mutual. Washington Mutual was handled extremely well by the FDIC. It was well orchestrated. It was run in a manner that it was done in the course of a week in terms of preparation. We represented one of the bidders, so I saw how they did it and we were involved, and it really was well done such that when it got to the weekend, actually it ended up being on a Thursday, but when it got to the point in time to take over Washington Mutual, which was a huge institution, it was taken over and there was a solution bundled up quickly. That couldn't be done without the government's ability to step in and take over. So I actually believe that's actually a powerful tool, and it's a way to deal with a lot of investor classes that indeed should lose money. But it's efficient and it's effective, and so I actually, that one's a very specific one where I think that's a pretty good idea from what I see, systemic risk. I'll let somebody else address confidence. That's a harder one.
Let's try that second question. How should the banking profession readdress their central role of funding growth, serving investors, and providing liquid markets? Eric?
As you probably figured out, I'm a fundamentalist that a bank can only lend if it has capital. And right now the banks have too many loans. The government has supplied capital to try to keep the banks lending, but the truth is that capital is consumed by the losses that already exist on the loans that were made. And it's our judgment that more capital is required to absorb future losses as we travel through this prolonged recession. We also have to recognize that if we say, as most of the regulators have, for any given loan, the bank must hold more capital against it, and it can lever that capital much less. But the cost of that loan is going to be materially higher. That's why I said in that abstract economic jargon, the cost of capital will rise throughout the economy. As it is, we have massive refinancings that still have to be undertaken in the corporate bond market and the commercial real estate market that will have first claim on the banks to try to stop those companies and projects going down. I would also say that as the economy begins to recover, we will be competing with the government itself as the world's largest borrower. And there are those who say there's going to be a real crowding out. You will notice that the long-term treasury rates continue to rise, partly because of the supply and the demand characteristics I mentioned, but also because of the inflation risk that pertains to term securities. So my view is there are going to be any number of very important economic projects and social projects that will get priced out. And we will have rationing of capital through price once we get through this transitional arrangement. If we say, well, we don't like that, we'll have these part-owned government banks simply lend to all of their favorite constituencies, then the next bailout will be some multiple of the one we've just experienced.
Gene?
Let me try the confidence, and I can't resist on a couple of comments on the other two. First, you can see why they didn't want me to tell jokes. The chairman of the FDIC has been enormously courageous. She's been one of our best regulators, and she is absolutely right. We will have public utilities unless we can resolve the larger ones. So you can't both be large and not be able to be resolved and pay big bonuses and be innovative. Can't be. So you've got to have the resolution. On confidence, it seems to me, in some degree, the mistakes we've made are really pathetically simple. We went through the last decade of a deregulatory mantra. The basic building blocks for good regulation have been in place. Oh, we've learned a lot from this horrible event, as airlines learn when they have a crash. But fundamentally, the tools for regulation have been there for quite a long time. But unfortunately, we went through a decade when the mantra was, let's let the markets be the markets, and we'll liquefy them if there's ever a problem. And it turned out to be wrong. It was an experiment, but we know what to do. The third point, I think, is really quite, and Sir Derek, I think, hit a lot of the key points. This third question, which is, okay, well, how are you going to get lending going? And the only thing I can add is that we have to be very, very wary of the re-regulatory cycle that I mentioned, because if you get regulators out there raising capital, squeezing down on lending so you increase standards, you get into the credit crunch environment we lived with at the late 80s, particularly early 90s, which really strangled the economy until it was turned around. That, I think, is an enormous danger going forward, in addition to the crowding out and the other sort of profound things that Derek mentioned.
Agnes?
Maybe another comment to it, maybe the third one, is what is the management of the different banks doing? I think the only way to get things going is also that the management of those banks is working with what they should do, which is actually getting the capital base, getting lending going, get the customers going. As long as you have, and my experience of a country that more or less went under in the early 90s, 92 to 94, in the way it was separated the toxic assets from the banks, so the management of the banks could do what the banks should do, and the toxic assets was dealt with in a different way, partly owned by the government, was a very successful restructuring of that banking sector. And I think lessons learned, one of the most important things is actually what did management do at the time? Well, they were running banking business and not dealing with a lot of other things. So go back to your question about how you need to get this going is also to have the management freed up.
Annette, you have the last word.
Just briefly, I think that investor confidence, once it's lost, is very hard to regain. And I agree with Jean that we had the building blocks here. We know how to regulate markets. We had the most active participation by retail investors in the world was in this country. And the good and the bad news of that is, obviously that's why we have so many people who are now hurting in this crisis. But we know how to regulate markets, and we know how to protect investors, and we just have to get back to our knitting. I think we went from, a concept of free markets to having really free-for-all markets, and we need to go back to a point where we, I would say, lend a hand to the invisible hand. And if we do that and we go back to what we know how to do well, I think we will hopefully regain the confidence that investors had in our markets.
Ladies and gentlemen, please join me in thanking this terrific panel.
Thank you. It's great.
Ladies and gentlemen, you've been very generous for your time with us today, so I promise you I'm not going to either delay you or attempt to trivialize the day's discussions by summing up in some brief package of conclusions. But as I said at the start of the day, we, the three organizations that put on this conference, wanted to put on a forum where leading central bankers, government decision makers, regulators and financiers could come together to discuss the three issues put before our panel. And some of you have been very kind with your comments in the course of the day. I think in many ways the best test for the success of a conference is if you have as many people in the room at the end of the morning as you did at the start of the morning, and even more if you have as many people in the room at the end of the day as you had at the start of the day. And that's a tribute to three groups of people. First of all, to the speakers who were kind enough to join us today, the speakers this afternoon, this morning, over breakfast, at lunch. Secondly, to our four corporate sponsors whose names are up there in front of you. And lastly to you, thank you very much indeed for joining us. We look forward to seeing you at the programs that our three organizations, sometimes collaboratively, sometimes separately, will be running over the course of the year. And we look forward to seeing you at our second Global Financial Forum round about this time next year. Thank you all very much indeed.